Election impact on India's markets. Let's bring in Feroze Azeez, Deputy CEO of Anand Rathi Wealth. Feroze, good to have you with us. What do you make of the rally we're seeing straight off the bat?
Yeah, what I make of it is, of course, the third term for Modi government is going to be a great news because capital markets lost status quo, point one. Point two, the kind of liquidity which has come from the domestic side, we believe that will continue, and that's where valuations re-ratings are possible. So point two. Point three, I think that the broader market in India has done well over the last one quarter years. I think that differential performance between the headline index of Nifty and Sensex relative to the small cap and the mid cap index should further continue because this is the best case scenario from a capital market standpoint, because the last time the NDA, which is nothing but the allies plus the BJP, had won 352. If anything more than that, there's also going to be a sentimental booster. The kind of capital expenditure this government has done, if that's going to be continuing for the next 5 years, the kind of GDP growth and the multiplier effect on the economy and the tax collections is going to be visible, and that's where the fiscal deficits could fall. So that's the excitement all about, and I think this should sustain for longer periods of time than a couple of days.
Feroze, talk to us about potential winners, bearing in mind the kind of policies that Modi stands for. We know that he wants to push infrastructure investment, he wants to push manufacturing, and a lot of people have said that perhaps, all the stocks that that belong to the Adani-Ambani circle would do really, really well.
Yes, Haslinda, that's definitely one of the key ones, because like you rightly pointed out, manufacturing and infrastructure is a broader theme. Defense, railways, roads and hardcore manufacturing are definitely going to get a push. That's one space. And like the Adanis and the Ambanis and the big conglomerates of manufacturing and other businesses will also get a push. But the most important push would come to the PSUs, because the way PSUs have been undervalued in India, and they've been always called value stocks because the way they function is very different than the private sector of India. I think that perception is changing. So the re-rating of the PSU, which happened over the last couple of years, will continue to happen, and in a very different way. So over the last couple of decades, the differential between PPs, for example, in financial services, between an SBI and an HDFC, that should converge over the next 3-4 years. So PSUs, especially financial services PSUs, because of the capital market infrastructure also developing over the next 4-5 years, will deplete. So you're absolutely right. Infrastructure stocks, some private sector conglomerates, and the PSUs and the CPSE index, which represents PSUs, will do beautifully well.
I mean, India's market has pretty much been driven by domestic investors. I'm just wondering whether this election will be enough to perhaps lure foreign investment in a big way.
Yes, I personally think if you look at flows from the 1st of April till yesterday, there's about $4.5 billion which have been sold. So FIIs have gone into this election result being very, very light. If you look at the index short positions, which increased of FIIs significantly, so 87%, 86% short vis-a-vis 14% long, is one of the least I have seen from a long standpoint. So FIIs have gone light. Last year, they added about close to $24 billion in the Indian capital markets on the cash side. They've redeemed about $4.5 billion. I think they will reverse that position and become net positive in this financial year over the next 10 trading sessions. And the FII shorts, which are 87% on the index level, should come down below 50% in the next 4-5 trading sessions. So that's going to be a lot of short covering. I think FIIs are generally on the election day over the last 3 general elections have been net buyers of close to about $500 million the last time around. I think this time there would be larger buyers as well, and the domestic flows will continue because India has about 8 trillion rupees, 8 trillion rupees of household savings, out of which only about 4-5% is in equity. So the paradigm shift between debt and equity for the domestic investor will continue because the sentiment doesn't get dampened because of the status quo and the third term for the government.
Feroze, it does seem like all the stars are aligned for India. 8% growth. We have S&P saying that it might just raise India's sovereign credit rating within the next 24 months. We have the RBI coming out with a better than expected dividend. Talk to us about the possibility of risks in the Indian market. What has not been factored in?
I think the larger risk to my mind from a Indian capital market standpoint is the tide turning from the domestic flows perspective. That's one. From the economy standpoint, I think the GST collections need to grow faster. If you look at the GST collection for the last year is 11.4% growth. Previous year there was almost about a 20% growth. So the growth slowed down. Of course, we are at the peak of the GST collection, but the growth in direct taxes has been greater than the indirect taxes. So that's point two. GST collection has to further grow. If we have to grow our capital expenditure at the rate which we project to do over the next 3-4 years, that's the second risk. And the third part is that the rate cycle should not get deferred in terms of correction, because the rates have been still elevated on the short end of the yield curve. These are the key risks for this financial year I would see very closely and take my decisions.
Feroze, thank you so much for being with us today. Feroze Azeez, Deputy CEO of Anand Rathi Wealth.